Okay, it's 7:30, so welcome everyone. Thank you very much for joining the bdhSterling presentation, buy-to-let property versus pension, which is right for you. Hope you find the presentation useful and beneficial. My name is Kevin Tutt. I'm an advisor with bdhSterling, and I'd like to introduce my colleague Paul Davies, who's also an advisor with bdhSterling and a company director as well. So
Hi there.
welcome, Paul.
Thank you. Hi there.
The presentation itself with a Q&A session, depending on how many questions we get, of course, will probably last somewhere in the region between 30 and 45 minutes. Just for continuity and make the presentation run smoothly, you'll see a tab, forgive me, it's either at the bottom of your screen or be at the top of your screen. It'd be a Q&A tab. Please feel free to type in any question that you have for myself or Paul, and we will run through those questions at the end of the presentation. Okay, thank you. So let's start the presentation. Just bear with me. Firstly, a little bit about us. We're based in Epsom in Surrey. I think we've got quite a few people who are all over the country who have joined us this evening. So Epsom is just west of London, for those of you who aren't familiar. And we also have 3 offices in Melbourne, Sydney and Perth. BDH as a company, we look after our UK-based clients for holistic financial advice. And we also look after clients who are emigrating abroad, who are in fact returning to the UK. And we do have a large amount of clients who are living in the UK, who have got assets in both countries, i.e. the UK and Australia. A brief health warning, just to say that the presentation should not be construed as financial advice. If you'd like to have a wider conversation around the content of this presentation and how it is relevant to your particular circumstances, then please feel free to contact myself or Paul, and we can have a meeting at a later date. So hopefully, as I say, hopefully you find it useful, but it's not construed as financial advice in any way. Some regulatory disclosures and risk warnings. We have our FCA registration number at the bottom, and the presentation is based on bdhSterling interpretation of HMRC's current tax rules, which of course do change with legislation over time. So this evening's agenda, I will look at the investment story with you. I will look at comparisons of both the investments, buy-to-let and pensions. I'll then pass over to my colleague Paul, who will run through the case study and the summary, and then the Q&A. Thank you. So if we start with why invest in pensions? Well, I've been in the financial services industry since 1993. And I have to say, majority of the press that pensions have received throughout that time have been pretty negative. Every budget, it's been forecasted that the Chancellor is going to reduce the tax advantages within the pensions regime. They keep changing the rules. For those old enough like me who remember a guy called Robert Maxwell and the Daily Mirror pension scandal that he caused, we had the pension mis-selling scandal, and also the Equitable Life debacle and British Steel as well. So anyone picking up the newspaper in the last 25 years who didn't really know much about pensions probably would have been put off just purely because of the negative press they've received. If we turn our attention to buy-to-let, why is it so popular? Well, let's have a look. Okay, I've gone back 25 years, which is normally the term of a standard UK mortgage. We've looked at the house prices in England between October 96 and August 2021, so over a 25-year period. The average house price back then in England was 54,931, and August this year, the average house price in the UK was £284,029. And that's according to the Land Registry data. Okay. So rather than put your money into bricks and mortar, if you'd invested your money into a pension, what would the comparisons be? Well, 54,931 from a basic rate taxpayer, that would have been an uplift to 68,663 with basic rate tax relief. If you'd invested that in the stock market in October 96, that would have reached 289,547. So broadly speaking, the two levels of growth are approximately the same. If we look at pensions tax relief, if you're a basic rate taxpayer, whatever you put into your pension, the government will uplift you by 20%. So 54,931, which was the average house price back in the day, would be the pension would have been uplifted to 68,663. For a high rate taxpayer at 40%, there'd be an uplift from 54,000 up to 91,551. So the summary of investment returns, as you can see on the screen, they're relatively close. £284,029 average property price increase in England, and the FTSE at 289,547. I know some of you might be thinking, what about rental income on top of that? Paul, my colleague, Paul Davis, will come on to rental income and versus mortgage payments, etc., a bit later on in the presentation. But just as a headline rate, I just wanted to let you know that the average property price, what it's increased by against the FTSE 100 within a pension. Okay, so if we start looking at some comparisons of the two investments, if we look at comparisons of costs, so the cost of entry, on the left, buy to let typically would have solicitors fees, mortgage setup fees, possibly renovation costs, agent fees, and the big one, stamp duty. With pension, you'll have an initial advice fees to set the pension up. The fee that advisors tend to charge now are flat fees rather than percentage of the size of the fund, but that will obviously vary from advisor to advisor. If we looked at the ongoing costs for a pension, you'll have ongoing advice fees, product fees, and investment fees all built into the plan. With a buy-to-let, depending on whether you have a letting agent, they will charge you a fee. You'll have ongoing maintenance costs, service charges, possibly freehold charges, and any mortgage interest that you're paying. One thing they have put there is hidden costs, your time. If you haven't got a letting agent looking after it and you are doing it yourself, looking at how much time you actually involve yourself with your buy-to-let investment. Comparison of costs at exit. Again, the buy-to-let, you'll have estate agents, solicitors fees, and potentially some mortgage exit fees. With a pension, you'll have product fees, investment fees, and if you are looking to draw your pension at that time, there may well be some retirement fees for some cash flow planning that the advisor may well charge you. Okay, if we look at comparisons of taxation, these tend to be the largest difference between all comparisons. At entry, you have stamp duty. Stamp duty was raised for second homes by additional 3%. So whatever rate the residential property fell into, there'll be an extra 3% if it was a buy-to-let. On that screen, you'll see the standard rate, which is for residential properties, and a buy-to-let second home rate. That actually changed during COVID that was slightly relaxed on residential properties, and stamp duty was actually suspended to boost the housing market. But from October the 1st, it's now reverted back to the current rates, which are on the screen. Just to give you some idea in the difference, if you were buying a property worth £400,000, the difference in stamp duty for a residential property and a buy-to-let property will be an extra £12,000. The entry costs on the taxation within a pension, well, there isn't any. You have, as we covered on a previous slide, you have income tax relief at your marginal rate, either 40% tax, 20%, 40%, or indeed 45%. Ongoing taxation, buy-to-let, any rental income, you're now taxed at your marginal rate. There's a gradual loss of interest tax relief, which I'll come on to in a mo. Depending on your income and the level of income that you receive, any rental income that you take, if you add that onto your total income on your tax return and it exceeds 100,000, your personal allowance would start being eroded. Remember, if you lose your personal allowance from the tax band, you lose your personal allowance it's equivalent to a 60% tax that you're paying between 100,000 and up to 125,140. A little bit of background behind that is, once you hit 100,000, for every £2 you earn over that, £1 of your personal allowance is lost. Okay, so within that level of income that you earn between 100 and 125, between that 25,140, the equivalent tax rate you're paying is actually 60%. Within the pension itself, investment, any gains grow tax-free, and there's no income tax within the fund of a pension as well. Loss of interest rates relief. This slide is quite a lot of information on there. So if I can just ask you to look at on the left, the tax year 2016-17, when 100% relief was then allowed. So on a typical example, £10,000 rental income, your loan interest was 9,000, you made a profit of 1,000. For a high rate taxpayer at 40%, you would pay £400. That's slightly been eroded away over the years, and up to 2020-21, that's now been lost. So although the loan interest tax reducer at 20% has been brought in to sort of compensate for the loss of relief, you'll see the last two boxes on the right. If the rental income was 10,000 and the loan interest was 9, exactly what you'd pay tax on. So you'd pay tax on the full 10,000 at 40%. You would get 20% loan interest tax reducer deducted. But if I can ask you just to concentrate on the bottom figure, you'll see the figures on the left from starting from 400 and go up to 2,200. That's for the same rental income and the same interest payments that a landlord would pay in tax over that period of time. So it has gone up drastically from 400 to 2,200 purely for the loss of the interest rate relief. As I say, that slide is quite a lot of information on there, but I'll just try to give you some idea of how much tax that particular person, extra tax, would pay over that period of time. If we looked at tax on disposal, well, a buy-to-let, the capital gains tax for residential properties, buy-to-let residential properties, is increased from 18 and basic rate tax of 28% for high rate taxpayers. The normal rate is 10 and 20, but the government have increased it to 18 and 28 purely for landlords. Comparison of retirement income. So a buy-to-let, your mortgage may have been paid off. you keep the property and take the rental income as part of your overall retirement plan. Any rental income that you receive, your income will be taxed at your marginal rate. If you took any income via your pension, again, your income will be taxed at your marginal rate. There's no difference there. However, 25% of the fund is payable tax-free, and you do have greater flexibility on how you take your pension. You use up part of your personal allowance prior to your tax-free cash. So overall, it does give you a bit more flexibility on how to take the income. You can increase and decrease it to be more tax efficient, so to speak. Okay, if we look at risk, now there's risk with both. On the left, the risk of a buy-to-let, void periods, if you can't get tenants for a period of time. Concentration risk, you're not diversified at all. Again, with pensions and buy-to-let, tax will change with legislation, and with both, there's an element of investment risk, quite rightly so. Taxations on death. A buy-to-let, you would suffer inheritance tax of 40% because the property would form part of your estate. Pensions on death. If you passed away before 75, any fund value within the pension is payable to your beneficiaries that are tax-free. Either a lump sum or an income, they would receive the funds tax-free. Just remember, for any pensions that you have, it's important that the trustees of the scheme provider know who your death benefit nominations are. That is very, very important that they are up to date. If you'd like to have a conversation with myself and Paul around the benefits of that and why it is so important, more than happy to discuss that at a later stage. But if you take away anything from this particular slide, take away the importance of death benefit nominations. Okay. If you pass away after the age of 75, the benefits are taxed again at the marginal rate, no difference there. But please bear in mind that some of the beneficiaries are likely to be basic rate or even non-taxpayers. I'll give you a quick example. If you passed away and your pension fund was passed through part of it to your grandchildren who are, say, at university, as non-taxpayers, they could take 12,570 per annum out of that pension, which would fall into their personal allowance, which would mean that there'll be no tax to pay. So just bear in mind that they will pay tax at their own personal rate. I know we have some Australians living in the UK on the presentation this evening. Just a couple of information around if you returned back home to Australia but kept your buy-to-let here in the UK. If you kept it and took the rental income, your rental income received would be assessable in both countries. Under the dual tax treaty, you will get a tax credit in Australia for any tax that you've paid here in the UK. On your death, unfortunately, your beneficiaries will pay 40% inheritance tax to HMRC, even though you're living in Australia, because your asset is here in the UK. If you move back home and then sold your buy-to-let at a later date, capital gains tax again is accessible in both countries, and under the dual tax treaty, any capital gains tax that you paid in the UK will be offset against your Australian tax bill. And the base cost for CGT purposes will be the value of the property on the date you moved back to Australia. It is quite common now, if you have several buy-to-lets, you may well set up a limited company for the purpose. If you just have one buy-to-let, this could be quite an expensive solution. But if you have multiple buy-to-let investments, this could be a very tax efficient way of managing that. From a buy-to-let perspective, any rental income that you receive, or when you sell the property, they're obviously classed as company profits, and they'll be payable at corporation tax rates, which are lower than personal tax rates. Mortgage interest is treated as a business expense for a limited company, which is a huge benefit. And unlike an individual, though, no capital gains tax allowance for a limited company. An individual will have 12,300 capital gains allowance per year per person. A limited company won't have that allowance available. Pension contributions, if you've made your pension contributions via a limited company, they'll be subject to corporation tax relief, commonly at 19% rather than personal tax relief. There is a potential to contribute more as long as you meet the whole and exclusive rules. Generally speaking, with a pension, you can contribute up to the amount that you earn per annum. With a limited company, there is a potential to pay more than your level of income, which can be beneficial for some people who pay themselves a relatively low income through their limited company. You can go one step further by a salary sacrifice, whereby you reduce your income by the amount of your pension contribution, and that will lead to a reduction in tax and national insurance. So these things can be considered through a limited company, whether you through a buy-to-let purchase or a pension contribution. Thank you for listening. I'll now pass you over to my colleague Paul, who will go through the case study and to summarise.
Right, so just to go through the case study then. So it's both a case study and more or less a recap of what Kevin has just said. So as you can see, we purchased photos of a couple of models for this particular case study. So the next slide, we will see on this particular occasion. So Paul contributes to a personal pension, and Kevin has purchased a 2-bed flat in Epsom as a buy-to-let investment. So again, let's have a look at that. So if we look at retirement and what benefits and what each individual can gain from this. So in the case of Paul, he can draw down from a pension using flexi-access drawdown. Of course, he could purchase an annuity as well if he wished. Of the fund that he's accrued in his pension scheme, 25% of the fund available is tax-free. The remainder is taxed at a marginal rate of income tax when drawn from the pension fund. Kevin, on the other hand, the property is kept and it is generating income for him. And as mentioned before, the income is taxed at 20%, 40% and 45%. This is on the assumption that he's owning it personally and not through a property company. And the property can also be sold. When it is sold, there is a gain at 18 and 20% tax. So a couple of things to think about in that in those particular scenarios. I think also what's important as well is when you're looking to provide this sort of kind of income, or you're looking to gain lump sums, I guess there's a little bit more liquidity in a UK pension. I mean, I suppose that depends what the underlying investments are. So you can get hold of the funds or the income or the lump sum in fairly quickly than in a property, which tends to be obviously a liquid. It's you know, if you need any additional amount and you're looking to sell the property, that can take time. I think on the flip side of that, though, a pension you can only get your hands on at age 55 and above, whereas if you did need a cash or a lump sum from whatever reason from your property by selling, you can sell that any time. Of course, it might take some time to sell. The next slide, please, Kevin. So if we sort of apply the situation that these two have died, first of all, before age 75. If you look from the pension point of view, the benefits from a lump sum. So this is assuming, of course, the pension we're talking about is a UK personal pension type arrangement. There are slightly different rules if any of you are in a defined benefit or final salary scheme. But if you're in a money purchase or defined contributional scheme like a personal pension or a SIP, the death benefits that are payable to the beneficiaries are as a tax-free lump sum. Death after age 75, the benefits are taxed at the beneficiary's marginal rate of income tax. So again, it falls outside of the estate for inheritance tax purposes, death and the funds within a pension scheme. But for anyone or any pension member that dies after the age of 75, the beneficiaries may well be taxed at their marginal rate of income tax. There might be exceptions if the beneficiary may live overseas or the beneficiary may not be at an age that they pay tax. With regards to death and you're a property owner, that residential buy-to-let property, regardless of age, will fall into the members' estate for and calculate for IHT purposes, which could be up to 40%. So, in summary, when you're looking at a personal pension or pension versus a buy-to-let property, some of the key points, and you can see up on the screen to think about, are the charges, the investment choice. Obviously, if you're investing in a personal pension type arrangement, then the investment choice is wide and varied. If you're property, the property is the investment. Growth and income assumptions. So you can obviously have within a pension, you can have growth or kind of income generating type investments, but obviously with the property, you've got the capital value of the property and the rental income coming to you. The tax rates, got to consider changes in legislation and tax rules, as we've seen from the table for kind of the rental income and capital gains tax, how those taxes have changed over the years. Similarly, for the tax incentives for a personal pension, they've changed numerous times over the years, which would include something like the pension's annual and lifetime allowances, which restricts, in the case of the annual allowance, the amount an individual can contribute to a UK pension each year and get tax relief. And in the case of the lifetime allowance, it's a cap on the amount that your fund can grow to. And then, of course, you've got kind of rental income and the mortgage, and obviously interest rates change all the time for mortgages. A good time to borrow at the moment, maybe not so much 20 years ago, but certainly is now. But of course that can change. And again, there's a question of inheritance tax. And certainly if you have your funds sitting outside of the pension regime with the exposure to inheritance tax, may need to look at something kind of life insurance, for example. Okay, thanks, Kevin. So in conclusion, I guess the question is, or the point is that both saving for a pension or having a buy-to-let property both have their place. So I'm not here to say as a general statement one is more beneficial than the other, because it depends very much on the individual and what's what capacity they might have to invest in one or the other, what their attitudes to one or the other are. Taxation can have an impact on it. That's whether you are in the UK or maybe you're looking to move abroad, relocate back to Australia. One thing you need to keep an eye on, though, is that rules do continue to change, and as as we've seen with some of the tax rules and various different legislations illustrated in previous tables. And overall, I guess maintaining diversity and having an element of flexibility can serve you well. If you put everything into property, yes, you very much got all your eggs in one basket. Although, a lot of people like to see, it's the bricks and mortar, it's there in front of them, feel it, touch it, that is my investment. Whereas if you invest in a wide range of assets like equities, bonds, gilts, and alternatives in a pension, you might be able to kind of hedge your investments overall. But again, it's down to the individual, and there's no right or wrong answer. So as Kevin said earlier, if you'd like to speak or chat to us, here's some of the contact details for you to contact us on. I think if you would like to contact us on inquiries at bdhsterling.com, we can certainly arrange for you to meet and talk to a financial advisor. And yeah, if you could also just give us like a broad idea of what you're looking for, that would be really helpful as well. And here we go into the question and answer stage. So if anyone's got any questions and answers, please can they put it into the little Q&A box or the little chat box, and I'm more than happy to answer some of those. Alternative, of course, if you want to kind of sleep on it and you've got any questions for later, please do drop us an email. But yeah, so if anyone's got any questions and answers now, please feel free to pop them in the box.
There's no questions at present, Paul, so we just wait. People are busy typing, so to speak.
Yeah. Okay.
Do you want to take that one, Paul?
Okay. So we have a question here. What is the tax rate on flexi access drawdown? So that's a very good question, and that tax rate would really depend on a couple of things, and that'll be on, first of all, on the member's own personal tax rate. So in short, it's assessed for tax at whatever people's marginal tax rate is. So if you think of pension like a deferred salary, if you like, so it's paid to you in any way, it would be like kind of if you're an employee and it's paid to you as PAYE. So the tax rate will really depend on your own marginal tax rate. Of course, 25% if you go into full flexi access drawdown. So if you're not taking it as an income and you're just taking everything out, you would, if you haven't already taken your 25% in entitlement, that would be tax free. So you've got 25% tax free, and then the rest of the fund, if you're drawing that all out at once, then that would be taken, or just that would all go into your, it will go through the bands depending how much you've got. That will all be assessed for tax in the year that you've taken it. But otherwise, like a regular income that you're drawing down from this pension scheme will be taxed at your highest marginal rates in the same way as employment income, like PAYE.
Paul, can I ask you, without passing the buck, so to speak, can I ask you to answer the second question as well. The reason that I'm going to ask you to answer that question, Paul, is just purely because you specialise quite a lot in our clients who are moving overseas.
Okay, so the question I have here is receiving buy-to-let income from the UK doesn't affect residency status in Australia, does it? And the answer to that is it doesn't affect your residency status, no. So you can have assets, you can be resident in Australia and have property, pensions, any amount of other assets you want in the UK still, but it wouldn't necessarily affect your residency status in Australia. The thing, if it's a buy-to-let property, an investment property, that wouldn't really have any impact. I guess that the impact would be is if you kind of maintain or state that your main residence is still in the UK, because you only really be living in, well, I suppose you have split residency rules, but you can only really be living in one country or the other. So, so having an investment property, buy-to-let property, that wouldn't affect your residency status in Australia.
Thanks, Paul. I'll just see if we have any other. No other questions coming through currently. If anybody else has any further questions, please please put them up and we'll do our best to answer them. We will be sending you the PowerPoint presentation. So as Paul said, if you have no further questions this evening, but you may want to have a look through the presentation again, have a think about any questions, and then ping them over to us by email. More than happy to take those on board and answer them and send them back to you, or arrange a call to run through those. Or we have well, thank you, Camilla. Thank you very much. There is a question in the chat box. Let's just open that up. I can't. There's a question in the chat box.
The question that I can see in the chat box is, if the property was my main residence for 10 years before letting, would the 3% stamp duty still apply on the first 125,000? So I think for the and that's something I'm quite happy to look into. But my initial thoughts on that, when we're talking about stamp duties, it tends to be on the purchase of a property rather than sort of converting one from the other. So I will, if you don't mind, I will come back. I will come back and revert to that. I've got the names of everyone in that, so that's a point I'm more than willing to check. But I'm pretty sure that it's going to be the answer is going to be, I mean, stamp duty is on the purchase of a property rather than moving from residential, to main residence to buy to let.
Any further questions?
Okay, well, thank you very much for joining us, everyone. Thank you for sort of taking up about 3/4 of an hour or so of your evening to join us. Much appreciated. And these things don't work if no one comes and joins in and listens and participates. So really do appreciate that. And so you've got our contact details, and as promised, a copy of the slides will go to you. So yeah, I think that would be it. So thanks very much for your time, everyone.
Thank you very much. Enjoy the rest of the evening.